SWAN on X says a crude bounce likely to prove short-lived into next week. As shown below, this fractional weakness in recent days has done little to no damage to the broader trend, with the SPX actually up 0.24%, as shown just scant consolidation after its breakout to new highs, and still appears likely to push back to a new all-time high sometime this month. But in fact, that's what actually caused markets to fall today, was a potential crisis in energy markets. It was reported today via a commodities analyst at a Swedish bank called SEB that said earlier this morning at about 7 a.m. that if Iran's oil facilities are destroyed, that could easily push oil to $200 plus per barrel. And then what happened at 10 a.m. is Joe Biden said that, quote, "We are discussing Israel striking Iran's oil facilities." So exactly what you don't want to happen, the geopolitical worst case scenario, if you will, or economic worst case scenario, shall I say, is exactly what is being talked about right now. Now, this is so important because oil is the most important commodity in the world. Everything, just look around, other way to put it, just look around. Everything you're looking at, you probably did not produce yourself. If you did not produce it yourself, it was transported to and fro probably many different places before you got it. That means oil touched everything. And that means if oil goes up, that affects everything. If oil goes down, that also affects everything. Now, over the past couple of recessions, you've always seen a spike in oil as well. And right before the recession, that is. Usually months before the recession. And a lot of bulls were saying, we never got that oil spike. We got that oil spike in 2022 and there was no recession. And now oil's falling, and maybe that means we just won't get a recession this time. Oil today is up 4%. But if oil went anywhere close to $200 a barrel, that would be a new all-time high for oil. Now, back in 2008, you seen this spike as we were entering into the great financial crisis, and oil hit $140 a barrel at the highest point. That was a huge spike. Back in 2022, oil hit about $123 a barrel at the high. That was the largest spike we've seen in a long time as well. If oil were to go anywhere close to $200 a barrel, if not over that, you would be in an economic disaster. Like, imagine if you live in California and gas is now $15 or $20 per gallon. If you live somewhere like Michigan and gas is over $10 a gallon, there's not going to be a whole lot going on. Just to get to and from work would cost dramatically more. And it also does a lot psychologically for people as well. I vividly remember in 2008, my mother was unemployed, so this could have something to do with it, but gas hit $5 a gallon, and in really inflation adjusted terms, that would be like gas today hitting like $8 a gallon, potentially more than that. I remember we were not going anywhere. We were not doing anything because it was just so expensive to drive. It has a big psychological impact on people. Even if gas were to only spike for a couple of weeks, it influences people's decisions to do this or go there or buy that or whatnot. And that's another big reason why oil spikes tend to happen right before recessions, because they tend to happen again when the economy is not that strong, and it's like that big domino that starts a chain reaction. So on top of election uncertainty in markets, on top of what was already geopolitical concerns for markets, on top of the port strike that is a growing crisis as we speak, well, now you have the potential for oil markets to get wiped out. That is the last thing we need as investors, but really as a society, is another large spike in gasoline. This is really what is affecting the markets most today. Because, again, it's a fine line between the economy actually achieving a soft landing and a recession. And this is a catalyst that would almost with certainty push the economy into a recession. In other news today, first things first, we had Challenger job cuts, which came in at almost 73,000, which is pretty abnormal in this time of the year as you're heading into the holiday shopping season. Normally, this is not when companies plan layoffs, right? Normally, this time of the year tends to be when Challenger job cuts are hitting their lowest points. And then to start a new year, that's where things rise as companies send out warn notices and plan layoffs. So this was a bad number today. Initial jobless claims came in at 225,000, up from 219,000 last week. The estimate was 220,000. So for Wall Street, that's paying ultra close attention to initial jobless claims. After a couple of weeks of declines, you're rising again as far as last week. And if that does start another rise in initial jobless claims, Wall Street's going to get more concerned. We did get ISM Services PMI that, interestingly enough, beat on the top line, coming in at 54.9. The estimate was 51.7. So that looks good. But if you actually take a look at the employment component here, it kind of plummeted from 50.2 last month down to 48.1. You are now under 50. That means employment is actually in contraction for the service sector. So not only manufacturing is in a contraction, now services are in a contraction for employment. That's not great. Now at the same time, which is just weird, services business activity came in at 59.9, much better than the estimate of 53. New orders came in at 59.4, much better than the estimate of 52. So what's going on? That doesn't make a lot of sense. Why is employment falling, plummeting, and new orders and business activity is actually rising? Very strange. Prices in the services sector also came in at 59.4. The estimate was 56.3. So prices going up more than expected. A bit of a mixed report. So as I showed, we had a lot of mixed data today, some which were good, some which were bad. The ISM Services report was really a head scratcher because some areas of that report were really good and then employment was really bad. I don't understand. Wall Street doesn't really understand why that's happening. Some people think it's a disparity that will either catch up to one or the other, meaning that economic activity, new orders, and business activity will come down to match employment, or employment will come up to match the other components. That's what Liz Young-Thomas on X, she is the head of investment strategy at SoFi, just said. She writes, ISM Services PMI surged to 54.9, significantly above estimates and the highest since February of 2023. Inconsistency under the hood, though, as employment is in contraction. Hard to have services accelerate with negative employment, so look for one to catch up or catch down to the other. We also did see a big jump in new orders, you can see here in blue, but this could have a lot to do with the port strike. So I think it could be safe to say that as this port strike goes on, there's going to be a lot less ordering. There's going to be less and less business activity, and you probably get a catch down in ISM services. So I would conclude that jump in ISM for September likely had to do with companies over ordering before the port strike actually happened. Now, Goldman Sachs writes on X, small cap election year seasonality for small caps. Time to buy the dip into week 4 of October is upon us. You're not going to time it right, so just continue to nibble all the way through seasonal trough. And basically, we are here. You tend to weaken over the next couple of weeks. Heading into the election, you tend to get the ultimate bottom and the bounce right before the election. Really, the end of October, beginning of November, you tend to get that ultimate bottom and then start that bounce. But I think there's so many different things that are happening right now, as I mentioned previously, all of the uncertainties, that doesn't guarantee a very strong end of the year rally like we are used to. Because again, I think most normal years, this, fall that you tend to see before the election, a lot of it has to do with only election uncertainties. Like that's usually the biggest thing affecting markets is the election. So sure, you get some downside, you rally after. Once you figure out who's in the White House, it really doesn't matter who wins, you rally. But now you have these economic worries, you have the port strike worries, energy market worries. We're not even really thinking about the election as of now. That's like an afterthought to people. So do we rally aggressively just because the election happens and it's over with? I can't make a strong case for that this time. Again, because there's so many other things affecting markets. Now, coming out tomorrow is the non-farm payrolls and the unemployment rate. Now, this data is going to have a very large effect on markets, for better or for worse. If it comes in good, then some concerns may be alleviated. If it comes in bad, then oh, hell could break loose in markets. We are expecting non-farm payrolls at 140,000. Anything less than that is going to be seen as negative, but really anything under like 120,000 is going to be seen as really bad, and you could see a large down move in markets. The unemployment rate is expected to stay at 4.2%. So as I've mentioned before, the unemployment rate went from 4.26% down to 4.22%. If it were to go back to 4.25%, so another 3-point move higher, you would actually go up to 4.3% on the headline number. Now, if it goes above 4.35%, then you go up to 4.4%. That's what we really need to be watching as of now. So in all reality, a 0.13% rise for the unemployment rate, which is not that large, would actually cause you to go up 0.2 on face value from 4.2% to 4.4%. And that's something the markets would really be concerned with. And I mean, I'm surprised markets are not more concerned heading into the non-farms tomorrow, because what we got today with ISM employment data, it was negative. ISM manufacturing employment data has been negative and was really negative last month. The Challenger job quits we got today is really just uncommon during this time of the year. That tends to be when less firing happens, when more hiring happens as you head into the holiday shopping season. Like, we really haven't got any good news on employment. So I think the estimates are probably too high. Even with yesterday's ADP employment change, like, was that really good? We came in at 143,000 job ads, but if you don't do a seasonal adjustment, you were actually negative 260,000 jobs last month in the private sector. That's not good. And I'm expecting if we get a non-farm payrolls report around 120,000, then markets likely sell off 1 to 2%. 1% would take the SPY down to 562. 2% would take the SPY back to about 555. If we get a non-farm payrolls number less than 100,000, let's say 70,000, which was, I believe it was Citibank's warning that we could get a 70,000 number, then you're going to fall 3 to 4%. 3% would take the SPY back to 550. 4% would take the SPY back to about 545 coming by tomorrow. That would be insane. Here on the day today, it's a pretty ugly day. The percent of stocks trading above their 50-day moving average is down to 52.79%. You do have about 4.5% of stocks today falling below their 50-day moving average. You have a new AI investor sentiment survey as well, and bullish investors at 45.5%, neutral investors at 27.3%, and bearish investors also at 27.3%. Now take a listen to this clip on CNBC that says, expect a sizable volatility event in October.
So right now you're looking at S&P futures. You say they broke through a key support level. Spell it out for us. Walk us through the chart. We made it. What are you seeing in the chart? What's that key support level and what does it say to you?
Yeah, I think when you're looking at the S&P futures, that's a December futures contract, and it broke down below 57.80. And that break below there was sort of this pattern where, we had such a huge run up from August. We had a little bit of a volatility event occur, that yen again, get 'em kind of action where people unwound the yen carry trade. And then the market rose and has kind of been topping out here. It broke below that 57.80 level. And so that's one area I'm looking for. We really haven't been able to get back above it. And as you see the futures trading lower, as you mentioned earlier today, this morning, that's a little bit of an indication that we just really can't get above there. So I'm a little bit cautious until we get above that 57.80 level.
So just to be clear, that's in your mind a bearish signal.
It is, and this kind of little pattern is almost a mini head and shoulders top. It's not like a wide range that a lot of technical traders look at, but when we're looking at a 5-minute chart and what's going to happen short term, and this little increase in volatility here to start October, to me, it's a little bit of a bearish move here. And that 57.80 level was really a critical level that we broke below. And so I think now the pressure is a little bit to the downside in the near term right now.
What about the pricing when it comes to downside protection? Has that significantly increased? I mean, we have had a lot of big macro events just in the last recent days.
Yeah, we have. And you laid out the weeks ahead here and all the events that we have going on, geopolitical and whatnot. And we have started to see put traders in the S&P 500 start to uptick the premiums that they're willing to pay relative to calls on the upside, right? So a put is a protection to the downside on the market. And we've seen a heightened level here over the last, let's call it month or so, where basically traders are trying to buy more protection to the downside than they really want to the upside. That trend completely reversed. Really, for the last 2.5 years, it's been the other way around, where we continually saw call buyers come into the market, any kind of dip in the market, traders were in there trying to buy the upside call. The reverse has really happened over the last 2 months, and that's a little bit concerning that institutional traders are out there wanting this protection for the downside. But look, obviously, a lot of geopolitical tensions out there in the atmosphere, an election coming next month, couple that with another Fed meeting at the beginning of November, 2 unemployment reports really in the next month, if you consider this Friday and the week of the election week. So,
well,
and
Brian,
then couple that with earnings, a lot of volatility to be expected.
I don't want to interrupt you, but you're spelling out, I think, the next question I want to ask you. What's the options market telling us about these upcoming events? You mentioned it just about a month away. The election's coming up. We have big jobs reports. We have a Fed meeting. I mean, what is the options market telling us about all that?
Well, when we look at the level of volatility where the VIX is at, I'd expect over 1% moves in the market back and forth on a daily basis. Now, we saw that a little bit to start October. We haven't really seen that the last couple trading days. It's kind of hung in there. I think it's waiting to digest the unemployment report coming out this Friday here, and then maybe make a move here. But certainly expectations are heightened that we're going to get a fairly sizable volatility event or move here coming up in October.
All right, what about the NASDAQ futures? I thought there were some interesting moves there. Kind of spell that out for us as well.
Yeah, the NASDAQ is sort of interesting, right? Because when sort of the yen carry trade unwound a bit in August, we obviously saw a lot of selling pressure in the NASDAQ. Sort of, it seemed like people were moving out of risky assets, heading into that 10-year note, the U.S. Treasury market, and the NASDAQ had some selling periods. And then all of a sudden it rebounded right back, really here, that 17,000, 18,000 level, I should say. And now it's kind of also stalling out a little bit. So that's something I'd be a little worried about, that we get this carpet shakeout back to the downside, some sort of retracement back towards those lows that we saw back in August. Maybe not all the way down, but something where the market's looking for a little bit of a pullback.
Wow, so he says a major volatility event is coming in October. Let me know what you think down below in the comment section. After all, that is what the VIX has been saying over the past couple of weeks. Also, you've seen the VIX just holding up, not going back down to those lower levels that we were at between, call it 12, 13, 14. It's still sitting at almost 20. Which is very elevated. Ladies and gentlemen, that is going to go ahead and conclude this video. Hit that like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.